This is an emergency broadcast for investors who care more about keeping what they have than chasing what's fashionable. When you see me attach a date to anything, you should pay attention. So here it is. If you're going to act, do it before February 1st, 2026. Not because I know the exact day the music stops, but because the signals flashing today look a lot like the ones I saw in 999 and 2007. And both times, a lot of very smart people were very overexposed when the tide went out. Let's start with a tool the press has taken to calling the Buffett Indicator, the ratio of total stock market value to the size of the economy. Years ago, I said in an interview that if the ratio of market cap to GDP gets up near 200%, you're playing with fire. In early 2026, depending on the exact measure you use, that needle is hovering around the 220, 230% range, well above long-term norms and firmly in what most models call strongly overvalued territory. What does that mean in plain language? It means the price people are paying for businesses in aggregate has run far ahead of what the underlying economy is producing. It doesn't tell you what will happen next week. It does tell you that expected long-term returns from the starting point are likely to be poor, and that risk is much higher than people behave. When you see that kind of overvaluation, your primary job is no longer to be clever. Your job is capital preservation. So here is the emergency part. I want you to look at your portfolio, and before February 1st, 2026, I want you to sell 3 types of things if you own them, not trim, not think about, sell. First, sell any story stock you can't value. Wall Street has always made a good living selling narratives. There's nothing new about that. The latest versions are companies wrapped in words like disruption, platform, metaverse. Whatever phrase keeps people from asking the one question that matters. What is this business actually worth, and how would I know? If you can't sit at your kitchen table with a pen and paper and come up with a sober estimate of future cash flows and a reasonable price you're paying for them, you are not investing. You're speculating on a story. In 1999, it was dot-coms with no earnings. In 2007, it was financial engineering you couldn't see through. In 2026, a lot of the most dangerous things have shiny AI labels and growth slides, but no demonstrated economics. Here is the test. If all you can tell me about a company is its story, big market, exciting technology, impressive presentations, but you have no grounded sense of how it will turn that into durable profits, sell it. If the only justification for the price is other people will pay more later, sell it. In frothy times, story stocks can triple on air. When reality catches up, they can also go down 80, 100%. You don't need them. Second, sell any investment you can only hold by borrowing. I have nothing against debt. Use modestly and intelligently. But when asset prices are stretched and people use leverage to squeeze out a little more return, that's when you start seeing lives ruined. I want you to look at margin account stocks you own only because the broker lent you money. Highly leveraged real estate that barely cash flows at today's interest rates and needs everything to go right. Structured products you don't fully understand, but that quietly embed borrowing. If you need borrowed money just to justify holding the asset, sell it. When valuations are this rich, leverage turns ordinary volatility into margin calls, forced sales, and permanent losses. A house with a sensible mortgage can be fine. A house that only makes sense if prices keep climbing at 10% a year is a ticking bomb. The same is true for any portfolio balanced on margin. Ask yourself, if this dropped 30, 40% on paper, would the bank or the lender force my hand? If the answer is yes, get out before the market decides for you. Third, sell any fat asset that pays you nothing. I've said for years that there are 2 kinds of assets, productive assets, businesses, farms, real estate that generate cash. Unproductive assets, things that just sit there and do nothing. Gold has been my favorite example. It doesn't produce earnings or dividends. You can polish it. You can look at it. But 100 years from now, the bar will be the same size, having produced nothing. I've said similar things about cryptocurrencies. Apartments produce rent. Farmland produces food, but Bitcoin produces nothing. That doesn't mean these things can't go up in price. They can. And sometimes they have spectacular runs, but their return comes only from the hope that someone else will pay you more later. When the environment is richly valued and uncertain, that's not capital preservation. That's hoping you're not the last one holding the bag. So look at any position in speculative cryptocurrencies and tokens, collectibles you bought because they were trending. Commodities or metals you own without any productive use attached. If they don't put cash in your pocket, rent, dividends, profits, consider them optional at best and dangerous at worst. In a capital preservation year, you want assets that earn their keep. Those are the three cells: storage stocks you can't value, investments you can only justify with borrowing, fat assets that pay you nothing. Now, the next question is obvious. Where does the cash go? For that, I want you to think about what I'll call the Treasury bill fortress. When I talk about sitting on cash, people imagine I mean a pile of $100 bills in a vault. That's not what I mean. For most investors, when risks are high and good deals are scarce, the safest parking spot is very short-term U.S. government bills or equivalent high quality, very short duration instruments. They pay a modest yield. They are backed by the full faith and credit of a government that can tax and print. They give you something incredibly valuable: optionality. In times like these, cash is not trash. Cash is the right to act later when others are forced to act. If you sell what is clearly speculative or fragile now and build a TT bill fortress, you haven't given up. You've just moved from the gambling table to the balcony where you can watch more calmly and wait. At some point, maybe later this year, maybe after, there will be what people like to call an I told you so moment. Some combination of overvaluation, leverage, and unproductive speculation will crack. People who were all in on story, leverage, and fads will be looking for exits. Prices on good productive assets will be pulled down along with the garbage. That's how markets work. In that moment, the investor sitting in a Treasury bill fortress with a shopping list of simple, productive, understandable assets will feel no panic at all. They will feel what I've felt a handful of times in my life: the peculiar calm of being one of the few with both cash and courage when others have neither. So treat this as what the title says: an emergency broadcast, not to scare you into doing something extreme, but to nudge you into doing something obvious while there is still time to do it on your own terms. Before February 1st, 2026, go through your holdings line by line. Circle every story stock you can't value, every position built on borrowed money, every fad that never pays you a cent. Make the hard, quiet decision to sell them. Move the proceeds into your own version of a Treasury bill fortress. Then wait, patiently, calmly, with a list in your desk drawer of the few businesses you'd be proud to own for a decade with no stock market at all. Capital preservation is not about fear. It's about surviving with dry powder so that when the crowd finally learns the lesson you're learning now, you're ready to act.